Next reading is aggregate output prices and economic growth. End of chapter questions. First question, which of the following statement is most appropriate description of gross domestic product? Total income earned by all households, firms, and government whose values can be verified. That's incorrect. The total amount spent on all final goods and services produced within the economy over a given time period. This is exactly what we are looking for. This is the most appropriate description of gross domestic product. The total amount, the total market value of resaleable, not resaleable, final goods and services produced within the economy over a given time period. The items that have been produced previously and they are just bought and resold, they are not included. So this is incorrect. That makes B to be the correct option. Next. The component least likely to be included in a measurement of gross domestic product is least likely. The value of owner-occupied rent, yes, it will be included. The annual salary of local police officer, it will be included. It's government spending. Environmental damage caused by production. This is clearly a byproduct of production process. So since it has no explicit market value, so it is not included in the computation of GDP. C. Next, which of the following condition is least likely to increase a country's GDP? An increase in net exports, it will increase. It will. Increased investments in capital goods, which in turn will produce more output, it will. But increased government transfer payments, we know government transfer payments such as job seekers allowance or unemployment compensation or welfare benefits, they are excluded from GDP. Hence, this is least likely to increase country's GDP. Next, C is the right answer. Which of the following would be included in Canadian GDP for a given year? In the reverse order, movies produced outside Canada. Since they are produced outside Canada, so they cannot be included in Canadian GDP. Electronics made in Japan, sold in Canada. Since they have been produced in Japan, so it can't be included in Canadian GDP. Yes, wine grown in Canada by US citizens. Since it is grown within Canada, so this will be included in Canadian GDP, remember. And since the wine was produced in Canada, and so it should be included towards Canadian GDP computation. A. Next. Suppose a painting is produced and sold in 2018 for $5,000 or 5,000 pounds. The expenses involved in producing the painting amounted to 2,000 pounds. Okay. According to the sum of value added method of calculating GDP, the value added by final step of creating the painting is the difference between the final selling price and 2,000, the expenses 3,000. So this is the value addition that makes B to be your correct option. A GDP deflator less than 1 indicates, now what is the GDP deflator? We know GDP deflator is equal to your nominal GDP upon the real GDP. So for GDP deflator to be less than 1, your numerator has to be smaller, your denominator has to be larger, right? So what would it mean? It means that prices have decreased over the period. Your real GDP exceeds the nominal GDP, which indicates that prices have basically fallen. Accordingly, deflation has occurred. B is the right option. The most accurate description of nominal GDP is, nominal GDP is a measure of total expenditure at current prices. Look no further. Nominal GDP is basically the value of goods and services measured at current prices. The value of goods and services at constant prices, this is incorrect. The measure to compare one nation's economy to another, this is incorrect too. Okay. From the beginning to the ending years of a decade, the Annual value of final goods and services for country X increased from 100 billion euros to 300 billion euros over a period of 10 years. The GDP deflator increased from 111 to 200. Over the decade, the real GDP for the country X increased by approximately, I'm sure you would know the formula. Real GDP a decade ago was 100 billion euros, and the GDP deflator then was 111%, which is 1.11. That makes GDP to be 90 billion euro then, and a decade later the real GDP is 300 billion euros, the time when GDP deflator is 200%, that's 2, so that's 150. So real versus real, the increase over the period is 60 billion euros, and 60 billion euros is what percentage of a decade ago's real GDP? 60 by 90 times 100, it's 66.67 or 67%. That makes B to be the correct option. Question number 9. If the GDP deflator values for year 1 and year 2 were 190 and 212.8 respectively, which of the following best describes the annual growth rate of the overall price level? I'm sure you would know. That's going to be straightforward. 212.8 deflator for year 2 upon the deflator for the base or year 1, that's 190 in this case, raised to the power 1 upon n, which in this case is 2 minus 1, and when you will simplify the whole of it, give you the overall price increase is 5.8%. That makes A to be the correct option. The numerator of GDP price deflator, first of all, the formula that you need to know is the value of current year output at current price level upon value of current year's output at base price level times 100. So when you talk about the numerator, that's the value of current year output at current year's prices, so that would make B to be the correct option. The value of current year output at current prices. B. Consider the following data for a hypothetical country: consumption, capital consumption allowance, government spending, imports, gross private domestic investment, exports. Based only on the data given, the gross domestic product and the national income are respectively closest to. We know what to do. For GDP, take consumption, government spending, imports, exports, and gross private domestic investment. These 5 elements, so it's going to be 15 plus 4 plus 3.8 plus 1.5 less 1.7, it'll give you 22.6. So this is going to be 22.6 trillion is your GDP, and that makes B to be the correct option. If you need to find out the national income is equal to GDP minus capital consumption allowance, which is 1.5. So 22.6 less 1.5 is 21.1. That further guarantees that B is the right option. In calculating personal income for a given year, which of the following would not be subtracted from the national income? Indirect business taxes, it is deducted. Undistributed corporate profits, it is deducted. And then unincorporated business net income. Unincorporated business net income, this is basically proprietor's income. This is a part of personal income, so this is not deducted. C. Okay, next we have equality between aggregate expenditure and aggregate output implies that the government fiscal deficit must equal to, well, we know the savings equation is equal to investment plus G minus T plus X minus M. So since we are talking about the fiscal deficit, make this the subject, G minus T, and it's equal to S minus I minus exports minus imports. Now, as you can see, fiscal deficit must equal to private savings minus investments, which is this part, and net exports, that is X minus M. Perfect. A is the right answer. Look no further. A is correct. Okay, because a sharp decline in real estate values, the household sector has increased the fraction of disposable income that it saves. If output and investment spending remain unchanged, which of the following is most likely correct? We know the function we just discussed in the previous question. S is equal to I plus G minus X plus X minus M, net exports. Since savings have gone up, there is no change in investment out of the equation. A decrease in government deficit. A decrease wouldn't make the equation balanced, so it has to have an increase. This is not correct. Decrease is not correct option here. A decrease in exports? No. In fact, an increase in net exports would make the equation balanced. So this is inappropriate. An increase in capital inflows? No. Rather, there would be an increase in capital outflow. Increased purchase of assets from foreigners. So this is incorrect as well. Then an increase in net exports, correct, and increased capital outflow, more purchases of assets from foreigners. So this is the correct option. C is the right option. Which curve represents combination of income and real interest rates at which planned expenditure equals the income? It's a very straightforward question. That's the IS curve. An increase in government spending would shift what? Well, since the LM curve embodies a constant price level, so that is out of the equation. Now, this implies an increase in aggregate expenditure. Government spending is a part of expenditure. So when expenditure increases, it will shift IS curve, and it will also shift the aggregate demand curve to the right. So that makes B to be the correct option. LM is rejected because LM curve embodies a constant price level. So that makes B to be the correct option. An increase in nominal money supply would shift the... Okay, so an increase in government spending would do what? Let's first see the saving function. G minus T plus exports minus imports. Okay, now if the government spending increases, that would result increase in savings, right? So increase in government spending must be followed by increase in savings. So if you just see this on IS and LM model, this is LM, this is IS. So increase in government spending would increase in saving, and that would result in IS curve shifting outwards. Since the IS curve is shifting outwards to the right, this would also result in a point of intersection between IS and LM at a higher level. So this will also push the aggregate demand curve to the right as well. So this will shift IS curve and the aggregate demand curve to the right, and that makes B to be the correct option. Next, and remember the important point here, that IS increase is increase in the aggregate demand. Moving on to the next question, number 17. An increase in the nominal money supply would shift the, let's say, first draw the IS and LM model. This is LM, IS. So increase in nominal money supply means the increase in real money supply. Increase in money supply would be followed by decrease in interest rates. And decrease in interest rate would shift your LM curve to the right. And lowering interest rate would also mean that now the new intersection between IS and LM is at the outside to the right. So aggregate demand would also increase. So that would be a shift in LM curve and aggregate demand curve. That makes C to be the correct option. Next, an increase in the price level would shift the, let us first draw the ISLM model. This will be a little helpful. ISLM. Okay. An increase in the price level. When the price level increases, now in order to decrease the demand for real money balances, interest rate must increase. So increase in interest rates would shift your LM curve to the left. So look no further, LM curve will shift. That makes B to be the correct option. Next, question number 19. As the price level declines, along the aggregate demand curve, the interest rate most likely, first of all, the decrease in price level would increase the increase in money supply, and that will correspond to the decrease in interest rate. So that would shift the LM curve to the right. So that would mean the interest rate would decline. That would make A to be the correct option. Okay, next question number 20th. Okay, the full employment or the natural level of output is best described as the maximum level obtainable with existing resources. Well, that will be potential GDP. The level at which all available workers have jobs consistent with their skills. Not true. There will be some stable pool of unemployed workers. Not all are employed. So the right option would be a level with modest, stable pool of unemployed workers transitioning to new jobs. So remember, the full employment, when the economy is operating at full employment, it means the economy is operating an efficient and unconstrained level of production. Companies will have enough spare capacity to avoid bottlenecks, and there is a modest, stable pool of unemployed workers that are transitioning into new jobs. C to be the correct option. Which of the following best describes the aggregate supply curve in the short run? Aggregate supply curve. Well, the short run aggregate supply curve is not flat. In fact, the very short run aggregate supply curve is flat. Incorrect. The long run aggregate supply curve is vertical. So the short run aggregate supply curve is upward sloping because input prices do not fully adjust to the price levels in the short run. So that's what we have discussed in our overview. C is the right answer. If wages were automatically adjusted for changes in the price level, the short run aggregate supply curve would be, well, the slope of short run aggregate supply curve, basically it reflects the extent to which the wages and other input costs adjust to the overall price level. So since automatic adjustment of wages would reduce the impact of price changes on profitability, hence firms would not adjust output as much in response to the changing inputs. So the short run aggregate supply curve would be steeper. B. The least likely cause of decrease in aggregate demand. Well, higher taxes will decrease the aggregate demand, so this is the likely cause of decrease in demand. A fall in capacity utilization, yes, this is a cause of decrease in demand. But weak domestic currency means that your export prices are attractive, so that would result in more exports, so that would increase your aggregate demand. So this is in fact the cause of increase in aggregate demand and hence least likely cause of decrease in demand. So your exports would be cheaper in the global markets and your imports will be more expensive for domestic buyers. So hence net exports component of your aggregate demand will increase. Moving on, so that makes B to be the correct option. Which of the following is most likely to cause the long run aggregate supply curve to shift to the left? Well, higher nominal wages, well, they will, but in the short run. Increase in the corporate tax, yes, they will shift, but the short run aggregate supply curve. But look at this, a decline in productivity. What productivity means? Productivity is the measure of efficiency of labor, and basically it's the output produced by per unit of input, right? So when the productivity decreases, it would decrease efficiency, and which eventually would mean that the labor cost would be higher, and that would mean the profitability would be lower, which means the firms will produce lower output at each price level. So this would result in a shift inward both in short-run aggregate supply curve as well as the long-run aggregate supply curve. So this is B, without doubt, is the right answer. Increased household wealth will most likely cause an increase in what? Household wealth means some financial or real assets. So when households have higher assets, higher wealth, so it means then they will still be able to meet their wealth accumulate over time, so they will spend more. Therefore, an increase in household wealth results in more spending, and hence it will result in increase in aggregate demand. So the aggregate demand curve shifts to the right. So that makes consumption expenditure, C, to be the correct option. The most likely outcome when both aggregate supply and aggregate demand increase. Okay, let's see. This is aggregate demand and short-run aggregate supply. So what will happen when both aggregate supply and aggregate demand increase? So this is new AD and this is new SRAS, which means what you basically it's a rise in real GDP, not nominal. So when there is a rise in real GDP, that would result in higher employment. So we can't say rise in inflation price level because we do not know the magnitude of increase in these. So what we are for sure that the real GDP would increase, that will increase in higher level of employment, a lower level of unemployment. Okay. Next, so that makes B to be the correct option. Question 27. Which of the following is least likely to be caused by shift in aggregate demand? We discussed in our overview a recessionary gap and an inflationary gap. They result from changes in aggregate demand. Remember? But stagflation, this is caused by leftward shift of the short-run aggregate supply. So this is least likely be caused by shift in aggregate demand. B and C, yes, but not A. Basically, stagflation occurs when output is declining, that is, short-run aggregate supply is declining, and prices are rising simultaneously. Discuss it in our overview. That makes A to be the correct option. Falling sharp increases in the prices of energy. The overall price level is most likely to rise in the short run. Well, it's an interesting question. So when energy prices will increase, it will cause a shift in the supply curve. Now, this is your short-run supply curve. This will shift inwards. It will shift the short-run aggregate supply curve to the left and thereby reducing the output, and this will result in increase in prices. So central bank must intervene to, if it doesn't expand the money supply, the slack in the economy will put downward pressure on input prices, and resultantly the shift in SARS will be back to the original position, right? So in the long run, the price level will be unchanged. So that makes B to be the correct option. Unchanged in the long run unless the money supply is increased. Next. Among developed economies, which of the following sources of economic growth is most likely to explain superior growth performance? Well, look no further. Developing economies, they have large labor supply. So this is not the reason. What developed economies have is technology. Technology is the most influential factor affecting economic growth in the developing countries. Technological advances are very important because they allow an economy to overcome the limits imposed by diminishing marginal returns. So A is the right answer. Which of the following can be measured directly? Labor productivity, straightforward, we can calculate this. It's simply output per worker, output per hour. This is something that can be directly measured without any ado. So that makes B to be the correct option. The sustainable growth rate is best estimated as this. We discussed this in our overview. It's a very straightforward textbook based question. growth in labor force plus growth in labor productivity. Straightforward. B is the right answer. Look no further. In the neoclassical or solo growth model, an increase in the total factor productivity reflects an increase in output for given input. Right? If you increase total factor productivity, it will result in output being increasing for a certain level of input. That makes B to be the correct option. Total factor productivity is a scale factor primarily reflecting technology. So an increase in total factor productivity means that output increases for any level of factor input. That makes B to be the correct option. The following information relates to question number 33-34. An economic forecasting firm has estimated the following equation from historical data based on the neoclassical growth model. Potential output growth is equal to 1.5 plus 0.72 times growth of labor plus 0.28 times growth of capital. Okay. The intercept 1.5 in this equation is best interpreted as the long run sustainable growth rate. No. It is the growth rate of total factor productivity. This is as per the standard solo growth accounting equation. This is the growth rate of total factor productivity. That makes B to be the correct option. Same question. The coefficient on the growth rate 0.72, this one, in this equation is best interpreted as labor force participation rate. Absolutely no. The marginal productivity of labor. Absolutely no. This is the share of income earned by the labor, because we are talking about the potential output growth. So it is how much is contributed by the labor and the capital. So this is basically the share of income earned by labor. C is the right answer. Next. Convergence of incomes over time between emerging market economies, emerging market countries, and the developed countries is most likely due to. Why is it so that over the period the incomes will converge? Because the growth rate of economies in the developed countries are lower, but whereas the emerging market countries, they have a higher growth rate. So at some point they will converge. So this is because of diminishing marginal productivity of capital, which means that as country accumulates more capital per worker, like in the US, Canada, and England, the incremental boost to output declines. Thus, all else being same, economies grow more slowly for developed economies as they become more capital intensive, and given the relative shortage and hence high marginal productivity of capital in the developing countries, they tend to show more rapid growth than the developed economy. This leads to convergence in income level over time. So that makes B to be the correct option. And that ends your aggregate output, prices, and economic growth.